So you clicked on this video because you would like to learn more about crypto cost basis and how it fits into your taxes. I'm a CPA and I'm here to break it down for you in 10 minutes or less. Let's get into it. So cost basis admittedly is one of the more tricky areas when it comes to crypto tax. I'm here to break it down for you and show you exactly why it's a little bit nuanced, but really how it works so that you feel confident moving forward. So overall, your cost basis, the formula for your cost basis is the initial purchase price of the asset plus any transaction fees. This is often missed by most people that come and work with us, is they don't realize that you can actually take those transaction fees and add it to your cost basis. And this is literally one of the easiest things you can do to reduce your capital gains, is just by baking in those transaction fees into your cost basis. So let's go over a scenario here, because the nuance is, well, I have multiple assets. I bought, maybe I dollar cost averaged, or maybe I bought like 3 ETH like this person, across a few different years, and then I sold 1 ETH. What do I use for my cost basis? So we'll get into that. So in this scenario, this person purchased 1 ETH in 2022, 2023, and 2024. So in 2022, they bought 1 ETH for $2,000 plus $50 in transaction fees, which result in a $2,050 cost basis. I just wanted to make that clear. You can add those transaction fees into the cost basis. In 2023, they bought another ETH for $1,500, so it dropped a little bit with only a $25 transaction fee. So overall, their cost basis on that ETH is $1,525. And then lastly, in 2024, early 2024, ETH pumped and was upwards of $4,000. And this person purchased 1 ETH for $4,000 plus a $100 transaction fee, ultimately resulting in a cost basis of $4,100. Now, the biggest misconception I see is people taking these amounts and just adding them all together and then dividing by 3 in the scenario and saying, this is my average cost basis. If that's the way you want to think about it for, mentally tracking your ups and downs, that's fine. But it's important to note that when it comes to taxes, these are individual tax lots that are disposed separately. So you can't just take the aggregation of this, sum it all up and divide it by 3 and say, overall, my ETH has this amount of cost basis, and then use that for your reporting. Instead, the IRS wants you to track each tax lot separately so that when you sell, like they do here, they sold 1 ETH, we're selling one of these specific tax lots. So here in 2025, this person sold 1 ETH for $2,500 in net proceeds. So the big question is, we know the individual cost basis for each of these tax lots, but what is my overall capital gain or loss? So overall, we know the fair value of what was received is $2,500, but we need to figure out what is the cost basis that's being disposed of here. And that's where your cost basis accounting method comes in. So what is your cost basis accounting method? Well, it's basically for scenarios like this where it needs to govern your sell order, right? You have multiple tax lots and you're only selling a portion of them. So what is the order in which we sell? What cost basis should we pull? Your cost basis accounting method is what governs that. So the default is FIFO. That stands for first in, first out. So the way that FIFO works is it looks at your oldest tax lot and then is like, that's the one that we sell. So for example, our oldest tax lot was this one we bought in 2022. And so since we only sold one of these 3, it pulls the oldest tax lot for the cost basis. Now compare that to LIFO, last in, first out. It's just simply the exact opposite. So it looks at all of our tax lots. It knows we only sold 1. And so it says pull the last tax lot first. So last in, first out versus first in, first out. Now, there's another method, and this is by far one of the best methods, and that's highest in, first out. This is what will minimize your capital gains always. So highest in, first out looks at all of your tax lots, and instead of looking at the oldest versus most recent tax lots, it doesn't look at the timestamp. It simply looks at the overall cost basis. So it says, hey, we purchased this ETH for the highest amount out of the 3. That is the tax lot that we are going to be disposing of first. Now, it's important to keep in mind, if we sold all 3 at once, then these these cost basis accounting methods wouldn't matter because you would just get the overall gain or loss. It's only for when you are selling a portion of your of your tax lots and not all of them that the cost basis accounting method comes in and governs that sale order. So let's look at the comparison because it's very, very important which method you are using. People that are sticking to FIFO are generally overpaying. FIFO is almost never the right option. Sometimes it's beneficial if you're trying to capture long-term gains instead of short-term, but FIFO is generally not that good. You can always use other methods like optimized HIFO. So what FIFO is again, it's first in, first out. So we know that the proceeds is $2,500, and this actually stays the same for all methods. The proceeds are the same. That doesn't change. We know we got $2,500 in net proceeds, so that's consistent across the board. Now, FIFO is saying first in, first out. So it looks at the timestamps, 2022, 2023, 2024, and says, okay, 2022 is the oldest tax lot. That's the one I'm going to pull from. So it pulls the cost basis, which was $2,050, and this results in a capital gain when that sale was made of $450. So if you were using FIFO, if this person was using FIFO, they would be reporting a capital gain of $450. Now, comparing that to LIFO, where they purchased, the last one they purchased was for $4,000, this is actually much more favorable. So in this instance, the proceeds, $2,500, doesn't change, but the cost basis of the oldest tax lot is what's used, so $4,100. So we take the proceeds minus the cost basis, and this actually results in a capital loss of $1,600. So comparing the two scenarios, you're either gonna report a $450 gain, or you could claim a $1,600 capital loss, which can then be used against other capital gains that you have, or even reduce up to $3,000 of ordinary income. So very, very favorable. HIFO is actually pulling the same tax lot as LIFO here because it looks not at the timestamp, but at the purchase price. And it says, hey, this tax lot was purchased at $4,000. That was the highest, the highest price. So we're gonna pull from this tax lot. Now, it's important to keep in mind, these will not always be the same. Generally, when prices are consistently rising, LIFO is gonna match up pretty closely to HIFO, but we know the cryptocurrency market, it's up and down all the time. It fluctuates quite a bit. So in order to ensure that you are minimizing your capital gains or potentially maximizing your capital losses is to use HIFO. There's other methods too, like optimized HIFO, which takes into account holding period, but we won't get into that in this video at least. So the big question here is, what is my capital gain or loss? And the answer is, it depends. It depends if you're using FIFO, LIFO, or HIFO. So based on what you're using, this is how you would calculate your overall capital gain or loss. The lesson here is that while doing the formula of proceeds of minus cost basis is fairly easy, determining the sale order when you have multiple assets or you dollar cost average and you have 1,000 different tax lots, that's where it can get a little bit tricky, and that's where tax softwares will help a ton. But really, this is how cost basis ties everything together. It is definitely one of the more nuanced areas when it comes to crypto tax. But hopefully this video helps wrap your head around how cost basis works and what a cost basis accounting method is. And by the way, my name is Justin. I am the head CPA at the crypto accounting firm CountonsheepYT, and we solely focus on crypto tax preparation. So if you work with TurboTax or a traditional tax preparer, that's perfect. That's where we come in. We handle just the crypto portion of it, filled out, ready to file, and then we pass that back to you so you can either plug it into TurboTax or hand it off to your tax preparer who might not necessarily know crypto like we do, and then you're good to go. And if you enjoyed today's crypto tax lesson, make sure to follow for more videos like this. And as you know, the crypto regulatory landscape is constantly evolving. So if you want help navigating the new guidance and strategizing around the new guidance, definitely follow for more. We are going to be releasing videos as news comes out, and we're going to be helping you navigate the new environment. So make sure to subscribe and turn on the bell notification for more.